Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's program is sponsored by Building Insurance and Risk. Don't put your real estate investment at risk. Work with Building Insurance and Risk and receive multiple coverage offers with a side-by-side coverage comparison. Go to buildinginsurancerisk.com to learn more. Today, my guest is Vimal Patel. Vimal is the president and CEO of Q Hotels Management, which develops and owns and operates hotels in Louisiana and Texas. He's been featured by Fox Business, Newsweek, the Associated Press, NerdWallet, Authority Magazine, NOLA.com, and others. And in just a minute, we're going to speak with Vimal about hospitality real estate. But first, a quick reminder. If you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. And you can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Vimal. Welcome to CRE PN Radio.
Yeah, thank you. Thank you for having me here.
Yeah, I'm looking forward to our conversation. Before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Yeah, so I'm with as you mentioned, Q Hotels Management. We are the developer, operator, managers in South Louisiana. We have 9 properties that varies between Hilton, Marriott, IG, and Best Western. So we have a couple of properties that we manage as well in Texas. We are also getting into multifamily, retail, and other avenues that we're looking into as well, which is storage facilities or assisted living and other avenues. So yeah, we are kind of diversify and branch out from the hospitality and a little bit do a risk management there.
Got it. So I'm curious. You mentioned the different brands that you have as hotels. Is there any limitation or any kind of friction you get between the different franchisors as far as your ability to operate other brands, or is that kind of understood, kind of like the car dealer that has Ford, Chevy, and Dodge or whatever? Is there any issues at the franchisor level?
Yeah, so specifically regarding so we have 4 properties right here in La Place, where our corporate office is as well. So we have Holiday Inn Express next door to Hampton Inn, and then across the street we have Best Western, and right next door to that is the Town Place by Marriott. So in regards to having a branded flag right next door to each other, there are no restrictions. However, this a story for another day would be dealing with the franchisors specifically regarding the tactics and some unfair business practices and some other that you get tie into for 15 plus 20 years of the license agreement. That's another conversation, because I last year actually in New Orleans federal court was one of the first one to sue the Holiday Inn brands regarding some of these unfair business practices. So that's a conversation for some other day.
Gotcha. Well, I was just kind of curious because it would make sense from an operational standpoint to have multiple brands in one area to capture more of the market. And I would think also you're able to do some cost sharing, or at least if you have staff, or whether you're buying supplies or whatever that is, that you can bulk buy in bulk or whatever. I would think anyway. I don't know if that translates or not. No, that's great. And so all of you have 4 right there locally that are like essentially next door or across the street from each other.
Right, that's great. We're next door to each other now. Now, obviously, each brand has a certain branded products which you really can both buy and use it at every hotel. But there are some other common materials, that you can use in regard to some of the cleaning supplies or some other products. But typically the linen products, the breakfast products, and so forth are branded, brand specific products. So you have to buy for each hotel separately for the brand recommended guidelines. So yeah, it's kind of very. And now there might be some options to save with the labor, where you could probably have a couple of director of sales in place where you can sell all the properties, or task force managers, or even rotate some of the front desk people here and there. So there are some avenues that you can benefit out of that, having a cluster in the same area.
Yeah, I guess that makes sense. The cost sharing would be a little limited based on everybody has their unique presentation there. I get it.
Right.
I get it. So tell me a little bit about just the hotel market in general. I know in the past 10 years, there's been, competition from like Airbnb and other, I don't know what they call it, sharing or whatever that. Is the market strong? And also I know COVID, was a kind of a wrench for everybody and just the whole economy. Are you guys, have you come out of whatever may have been the COVID lag, or is that gone now? Are you guys
Right.
full?
Yeah, so obviously, March of 2020, we got slammed. We were running, somewhere around 75-80% occupancy at the time, and all of a sudden it just grinded to a halt, and we went down to single-digit occupancy. Right, we had to even close down one of our hotels, Hampton Inn, at the time, just to kind of mitigate some of the cost expenses and so forth. The biggest challenge has been, again, we had mortgages. We have fixed costs for the insurance, utilities, and some other aspects. We have team members that rely on some of the benefit packages and then some basic wages. So there was a lot of challenges, that we had to kind of dig up, some of our line of credits and just kind of make it work to be able to self-sustain in that essence. There was some grant help from SBA for the PPP that really helped the hotel operations, and supporting some of the team members. But again, the mortgages are due. Even they get extensions, you still had to pay for it. So the liquidity became a huge problem. Yeah, and then as you exhausted line of credit, and as the property debt coverage ratio went down, some of the line of credit got wiped out, or are no longer available. Because of the valuation, right? So there were a lot of challenges there in the regards. 2021, we started picking up, and things were going in a little bit better directions, better occupancy. But then in August, as I talked earlier, Hurricane Ida hit, and we came down right above our town. We got 7 properties within the vicinity that got hit pretty bad. It took a long time to recover from that, dealing with the insurance company, dealing with supply chain issues. And as a matter of fact, 2 hotels are still down. There's work in progress on that part after almost about 8-9 months. So yeah, those have been a bigger challenges for us specifically. Getting out of the COVID zone, and trying to see some optimism, and the light at the end of the tunnel, and then here comes the Hurricane Ida, and just kind of we're starting all over again. So it's been a challenging past 2.5 years.
Yeah, no, I can only imagine. Get through the COVID thing. Things are going back, and then you have a hurricane. That's rough stuff. So the location that you are primarily located in, what was the name of the town that you're in?
Laplace. So we are Laplace. We're about 12 miles west of the New Orleans airport. Our town is located where I-55 dead ends on I-10.
Okay, gotcha. All right, so you guys are kind of right down there in the kind of the eye of or at least that hurricane risk is a regular thing for you. But I'm assuming is the tourism pretty strong? You mentioned you guys are back. Is that primarily your market, or is it just travelers that are traveling across the country, or is there any kind of
Yeah. So yeah, our market for Laplace itself, we're dependent on oil and gas. We have a lot of industries nearby on the riversides on both East Bank and the West Bank of our town. And so we are dependent heavily on the oil and gas industry, right? And the tourism is not directly affects us. However, when you have a large events, festivals, or the convention center has the larger groups in it, we might see some overflow on it. Predominantly, it's a corporate-driven market, and we will see some overflow here and there, maybe on the weekends and something like that. But other than that, we don't really a whole lot of depend on the New Orleans overflow.
Gotcha. So more business travel for the oil and gas industry.
That's
Kind of
correct.
your gotcha. So you guys develop properties, you operate them, and you manage them. What are some of the things that you guys pay most attention to when looking to develop a property?
Yeah, so the biggest thing is obviously we want to look at it is what market that we are getting into and what brand we want to get into. So there's associations with whether want to get the upscale, mid upscale, economy brand, whether it's extended stay brand. We tend to stay out of the full service hotels where you have the food and beverage components involved. It's the margin is simply not there in those kind of brands or hotels because of the food component, which traditionally is not a money making revenue generator for the hotel. I mean, some market they'll work, but in most of our market, we stick with the limited service scope, whether it's upper mid scale or extended stay properties. So that's where we start off with, and then obviously we do a study on whether the market is sustainable, how the competitor hotels are doing it. We do a star report on that. We'll do feasibility study. We'll assess that if there's a future additional hotels that may come along, would be able to kind of self-sustain ourselves. So that there are a few other aspects that we kind of able to dive in there, and then obviously dealing with find the right brand, the right fit for a market, and then obviously how many rooms you want to do, right? So the cost of rooms will dictate nowadays what the hotel that used to be 80, 90 or 100,000 a unit is now costing us north of 150,000 a unit, and it's constantly going up post COVID, right? So there's other factor in play, and the one last thing would be that you got to have X number of rooms, right? So you just can't go with 60, 70 rooms anymore. The cost of operations and the fixed cost involved is just way too much to have this as a low key. So you trying to push it as close to the 100 as you can, and obviously that will bring your project cost high as well. So your net worth, your liquidity, and the bank loan to now they're doing probably about 65-70% versus before they used to do 70-75% to ratio. So yes, all those factors plays in.
Yeah. No, and when you guys, so let's say you find a location and a brand that you think will work. Once you decide that you're going to go forward, how long before you're actually operational? I mean, once you sign the papers, but you don't have a hotel yet, you got to build it. How much time is that? A couple of years, or are you able to get that in a year, or what's
No. So minimum is 2 years, right?
2 years?
That depends on the city as well, because like if you go in a Florida market, right, the Florida has a little different sets of laws, and there's zoning requirements, and then there's you have to go through this permitting process, approval process. If you change the zoning law, zoning requirement, then it's another process. So yeah, I mean, yeah, in least amount of time would be minimum 2 years. It could drag on to 3.5 years, or even more, depending on which state, which city you might end up in. So it's very varies in which area you want to build it, and what are the current local zones and laws are that you have to go through here.
Got it. So once you have the property, it's built, it's operational. Do you typically find that the newer properties, do they get a boost? I mean, is it like people have seen this for a long time and now they're finally like, wow, we could stay there, kind of thing? Or is there any kind of initial
Right. So no, it's quite the contrary, right? So new property takes a little bit longer time to ramp up.
Okay.
Typically, we give 12 months to 18 months worth of timeline to ramp up property because you had to get into your corporate accounts. You had to get into RFP process. And you had to get the circulation going for other companies to know. So it takes a on an average 12 to 18 months for the period where the property will ramp up. And that's on an average. Sometimes some properties may take 2 years, right? So it all depends on your brand, your market, and how strong your market is as well. That will dictate. So you have to be prepared to have some cash reserves for the first 18 months, to be able to pay your debt.
Yeah. So you're if once you sign the paperwork and decide you're going to go forward, you're 3 to 5 years before you have a stabilized asset. Is that kind of what I'm
Oh
understanding?
yeah, definitely, yeah.
Yeah.
It's a long-term process. Your time factor it's pretty high, so you have to kind of survive. Going through again the zoning process, the site plan review, the building permit with architects, dealing with civil engineers, and then finally finding the general contractor, and then again, there might be change orders. There's other avenues that play in part. So yeah, it's a building is not easy. It is always recommended if you can find the right product. If there's a market, you might as well spend extra and buy that rather than building it. But again, if you're a developer and that's what you do, then you're used to it at some point. But it's never it's never the same target. Right? It's always a moving target. It's always new lesson to learn. The cost is always going to go up. It's going to overrun on time. So yeah, it's a variable in each project.
Right. Now you mentioned potentially buying an existing asset as opposed to developing it. Um, I know the timeline we've talked about, but I'm assuming that is there not uh, a profit, or not a profit, but an equity uh, gain that you get from developing from ground up as opposed to buying an existing operating asset? Or do you recognize that, or is it just by the time you get there 5 years, it's kind of a
No, so again, I mean, if you're talking about equity part of it, so again, it goes by where what your loan amount is, 25% of the purchase price of existing property, but that's what you're putting down, and that's what your equity is. Like similarly in the new construction, if your loan is if a project is for 10 million and if you're coming out with 2.5 million, that's your equity. So equity, I don't think doesn't play much of a role in it. It's the time, the return on time, right? So
right,
everybody talks about the return on money, right? But what I think most people that don't calculate is what is your return on time, and
right,
if you have to overpay a project now that's going to save you, that's going to grant you 3 years a head start, and then you might able to take that depreciations. You might want to take down some of the losses, or if you are in the 1031 market, so the different ways of that you can play that part role in it. Again, it all varies by the situation, your risk level, and your financial strength, and how you want to pursue this.
right. So you mentioned depreciation. Do you guys utilize cost segregation studies, or is that not something you do?
Yeah, so we have done for a couple of properties, and then that's the property that we intend to hang on for a while. The other properties that we were not too sure whether we will hang on or we may sell it. We didn't do it because again, look, at the end of the day, everybody needs to realize that the IRS always come and get you, right? So
Right,
you may put today's sorrow, pass it on till tomorrow, right? But at the end of the day, you still have to pay taxes. You still can't get out of it. So we made an educated decision where in certain properties we didn't take the deductions, and we kind of left it, and we didn't even take accelerated depreciations, and we just kind of let it see if the basis that it build up, and if we do decide to sell it, then maybe our tax implication will be much lower than if we would have taken it. So we just kind of decided to play that game that may fit best for some of my partners.
no, makes sense,
Yeah.
case by case. So with a hotel, property, I'm assuming you have just constant capital improvement, with whether it be replacing carpet, uh, whatever it is, updating the pool or whatever that is to keep that fresh and inviting. Is there, and you mentioned some of the other asset classes that you guys are getting into, multifamily and that. Um, is there do you see a more significant, uh, you know, budget item for capital improvements and replacement of things in the hotel business as opposed to, the other asset classes, or is that more of an operational, just a cost? Uh,
Yeah, so it kind of varies between the age of the building, right? So if you have a newer building, the typical term is a 7-year window where you might be changing out your soft goods, your carpet, you might be refreshing your paint, your FF&E, the furniture, fixture, furniture, you might stretch it out to maybe 10 years if it's in good conditions, right? If it's not started showing wear and tear, brand will always when doing the QA inspection, brand will always tell you whether you're on these capex items, you need to set up a timeline. Upon renewal of the license, which typically, a 15-year window, that there is a major upgrade that's needed. The brand requires a major PIP. So you'll be doing spending 1.5, 1.8 million, 2 million, depending on the size of the property, to renovate and renew the license. But normal wear and tear, that is the, depending on how busy your hotel is, what market it is. We're in South Louisiana, there's a lot of humidity as well. So this kind of plays role in it, and you have to just kind of having a 3 to 4% reserves built in each month, so that way you have those funds available for you when this time comes to invest in the capex.
no, that's good to know. The 3 to 4%, that makes sense to have that in reserve, so you're able to easily take care of that. So as a hotel operator, do you guys, or actually is the development and the operator and the management, do you own and operate the property in the same entity, or do you separate? Do you have an ownership, asset owner entity, and then do you have an operator entity that
Yeah.
operates
So
that? Or
so each hotel is a different entity, because they're not the common ownership as well. There are different partners, different ownership. So each of the hotel is different entity. The Q Hotel Management Company is a different entity, which doesn't just strictly a management company. So yeah, we got to by default, we had to have the hotels in different LLC because of the separate different partners and different breakdown of the percentages. And then we have a GC. We also have a GC license that we've built. So Velocity Build is our company. So we do build separate LLC for the constructions. Q Hotels does the management, and then the each entity kind of owns the hotel. So we kind of do we all 360 in house.
got it. But as far as the operation is separate from the ownership of the property, is that how you set that up? Okay.
Yeah.
Got it.
Q Hotels manages all the hotels. So Q Hotels is a management company for all of the hotels. Yeah.
Okay. And is it a practice, or do you ever see this where somebody just operates leases a hotel and operates it, as opposed to owning the hotel, the asset?
Very rarely. Most of the cases, if a developer is going to build a hotel, it makes sense to own it and just give it to a management company to operate it, right? Leasing part kind of opens up a little bit more risk because you have to deal with the brand. You have to deal with the insurance, and some other liability that comes along with it. So unless is a very lucrative lease, and you're able to make the insurance work, you would make the brand license works and so forth, but it's not typical to see that kind of a lease program. Yeah.
Got it. So is there an average hold time? You mentioned sometimes you guys buy property and it was kind of a determination as to whether or not you might do a cost segregation study, if you're going to keep it or you're going to sell it. Is there, do these trade on a regular basis?
Yeah, so it depends. Again, so that a lot of dynamics in there, right? First of all, if you're spending, if you're able to build out a property at a lower cost, let's just say then we said that the old cost was probably about 100 a key, and if you're able to make it to 95 or 92,000 a key, that's a good sign. So you may be able to kind of have a quick turn and flip it. It's also dynamics about your partners, right? To see yeah, where are they at, and different age group of partners. We a couple of partners that were 60, and so forth. So they may have some other guidelines, the other requirements in their financial situations, and then also what works right now. Do we have the product that is going to be at the peak and we can get the max out of it, right? If there's a slow start, like I mentioned about with the 18-month period, then a property evaluation is probably going to take some little bit of time. Versus if we have a jump start right away and you feel they can get the max out of it, because again, the year 2 and year 3 is still to come. And so the buyer will see there's still a lot more upside, and you can get probably 120, 125, 130 a key. That's something. So it's dependable by individual situation with the market, the cost to build, and again, and what's your risk factor? Do you want to just take what you got and run with it, or do you want to bet for the future and see if you can gain more out of it? So again, it all depends.
Oh, that's it's interesting how well, I guess it's true. I mean, it's anything, it's numbers. If
Yeah.
what your plan is, if your plan is long term, that's one plan versus if it's shorter term or whatever. So you mentioned the ownership. You've different investors in different properties, and that. Do you typically do partnerships when you acquire property, or do you do syndications, or how are you set up on the attracting the capital and putting the
Yeah, so in our case, it's just a family business, right? So
okay,
right now we just have 4 partners.
okay,
So it's all family within right now. We had a couple of other partners from before in that part, but then and later on, last 7-8 years, we just kind of narrowed down to us 4, and we're just developing and managing and doing the assets. That way just makes it easier, because we have segregation in divisive duties, where a couple of my partners are strictly into the constructions and rebuild and the GC part of it, versus I can manage finances, operations, and brand relations, and some of the other aspects of it. So they kind of helps out and depends where the expertise are needed, and that way you can share the workload, and then nobody can jump into each other's work, and it'd be a lot easier and a lot smoother transition. So it kind of worked out pretty well for us, and that's what we have. And now moving forward, the goal would be that when we're doing a larger project, which will exceed 35-40 million dollar projects and $50 million projects, then we might seek outside investors, or invite some other partners, or build a fund. So that's some of the options that we're evaluating, and see how that would work out. So we have a couple of projects right now that we are doing. As I mentioned earlier, the multifamily. So that's going to be probably about 36 million project, 150 rooms, units. So that'd be a good I guess product in our asset and on our portfolio, and that will probably will allow us to go outside of Louisiana and then do a lot more projects, and maybe do multiple projects in a year, versus having to do one at a time with a limited partnership, where we can, if we get the outside funds, and be able to do 2 or 3 projects in a year, and kind of just scale it from there.
yeah, no, definitely the more opportunities. And you said that that's a multifamily project you're
Yes.
you're working on. Okay.
Mhm.
And do you find as far as the construction and the development process, kind of a similar timeline uh, as to what you find with the hotels?
Well, one thing for the multifamily would be that there's you don't have a brand that can dictate certain guidelines, right? So that there's a little bit more free, and you still have to make the code. You still have to go by the regulations and all of that. So that doesn't change a bit, right? So what would help you would be in the designing part of it. or pre-opening process part of it, doing the CO and so forth, where you are your own I guess inspector to make sure that the codes are met and the inspection is done and the life safety is done and so forth, and then it would open it. If you have to change certain designs or certain elements, you're not going to go out seek approval and wait for that. So that kind of works in your favor because you don't have brand involved. But the building part of it and the construction part of it is pretty much the same timeline.
Got it. Got it. And as far as the hotel business, we've talked a little bit about kind of coming through COVID, and I asked you briefly, we didn't really talk about it, but like Airbnb, do you see anything changing the hotel business going forward? Is it pretty much the same thing? People needing temporary shelter for travel or for business, or
So the
is
hotel
that
industry is kind of in a very unique position right now. There are several factors playing in that. Even if you discount the Airbnb part of it, if you just think about it, we have labor shortages.
yeah?
There's a labor shortage across the board, across the country. Even internationally too. I just saw that the news article that Heathrow Airport is limiting the traffic to 100,000 and telling the airlines don't sell tickets anymore, right? So labor is a big problem. So most of the hotels have scaled back the housekeeping service. They've scaled back the food and beverage operations because simply you don't have labor. You cannot sustain, you cannot provide service. The cost of the wages have gone up 35%. Yet you cannot fill the positions. The cost of insurance, for in our area, where we South Louisiana Gulf region, Florida, it has tripled. In 2020, for eight hotels in 2020 of March, when we renewed it right before the pandemic, it was $426,000 for the property insurance, wind and hail, GL, and all of that, right? March of 2021, same properties, 8 properties, right? It went to 626,000, right? March of 2021, same 8 properties, it went to 1.8 million.
Oh my God! So you
Yeah.
more than
So
doubled, tripled,
yeah.
tripled.
So
Oh,
that's the thing. So that part, your inflation right now is just playing a heavy role. Your Fed's raising the interest rate, so most of us has the prime plus rates on it, right? Supporting rate. The mortgage payment has gone up. So there are a lot of factors playing in part of the hospitality industries. So we had to raise rates. We cannot self-sustain, and yet the services will be scaled back because there's labor shortages and other factors playing in part. Your bottom line still is not there, is eroding. And then you take out the Airbnb part of it again. Airbnb doesn't have to play by the same rules. They don't have same safety standards. They don't have to have insurance. They don't pay taxes in the local community, occupancy tax or otherwise, right? So yeah, so those are the factors that are playing through right now, and a lot of things coming out. It's going to change how the industry operates, and then the adaptability of the customers moving forward. It's going to be eye-opening experience for all of us.
yeah. No, I think the eye-opening experience is definitely
Yeah.
the underlying theme here. I mean, it is weird. I was just kind of doing a little bit of a comparison thing. You look at like the price of fuel or food or all of it. I mean, just how the doubling in many cases is what it is, but tripling that's a huge deal. Have your rates, have you been able, you mentioned how you've had to increase rates, but I can't imagine, have you been able to double the rates to get to
No, I mean, that's the challenge, right? You
yeah,
can do, there's a small increment, you can go up 10, 15, 20%.
right,
Yeah, but you can't jump from $100 rate to $200 rate. That's simply not going to work, right? So it's not going to sustain either.
right,
But again, that's another part of it is diversifying, right? Spreading out your risk. It's no longer sustainable with all these different elements. It's taking away, eating up your margin, and your investment is pretty heavy, $10-15 million investment with a personal guarantee on it, so it's a huge challenge right now for a lot of us, what the future holds.
all right. You mentioned the investment there. Lending, is that, do you primarily work with commercial banks, or I mean, I can't imagine it's already Fannie, Freddie I'm assuming there's not a Fannie Freddie option for,
No, yeah.
yeah,
But yeah, a lot of local banks, you can get private capital as well. That's always expensive.
yeah,
There are CMBS options as well. We had a couple of hotels with CMBS. We got out of it. It just simply, it doesn't sit well if you want to hang on to the asset. But most of the dealings that we do is try to find the local banks that we have relationship with
right.
that can help you out in time of need, and then you have somebody to talk to, and just kind of have that peace of mind.
Yeah, no, I find a local bank that's a member of the community has a lot more interest in your success than somebody far away. So
Right.
I get it. So, hey, Vimal, if we could, I'd like to shift gears here for a second. As I've mentioned by day, I'm an insurance broker, and I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically look at. We first look to see if we can avoid the risk. When that's not an option, we look to see if B, we can minimize the risk. And when A and B are not an option, we look to see if we can transfer the risk. And that's what an insurance policy is. And as such, I like to ask my guest if they can look at their own situation. It could be clients, investors, the market, interest rates, the economy, political, whatever you think is the biggest risk. Um, and for clarification, I'm not looking for an insurance related answer. So if you're willing, I'd like to ask you, Vimal Patel, what is the biggest risk?
Yeah, so as I mentioned right now, the biggest risk right now is again having the personal guarantee that you have on your debt, right? The loan. The cost of operations has gone up. The fixed cost has gone up. The revenue has not gone up in that percentage. So coming out of the COVID, getting extensions, and now dealing with inflations and rising interest rates and rising costs and so forth. You want to maintain that, because again, if you start lacking on your mortgage payments, if you can't pay it, and your liquidity is running out, the net worth is getting out. That's a huge concern, because that pretty much underlines your future, your assets that you hold, your future of your kids. That's the biggest risk part of it. Obviously, the other part hand in hand goes with it. Again, as I mentioned about the hurricane, right? So we went to the hurricane, and again, we dealing with insurance companies is a huge challenge in this part. It took us, 7 months to kind of settle the claim and get the funds. In the meantime, we had to use our own line of credits and get more debt to continue rebuilding it while we were negotiating and fighting the insurance company. So having the property coverage is the biggest factor, because we just went through that part. Right coverage with the right deductible, knowing your coverages, and be ability to have a plan in place should a disaster occur. Right, you're not scrambling to find the right resources, who to get in, who to help out with, whether it's a public adjuster, whether it's an attorney, or whether it's a mitigation company, or whatever the case may be. Right, so you got to have those plans in place, because absolutely the day of the disaster, or the day after the disaster, there'll be a million other people lining up and taking the great job for you, and then you'll overpay them, job, and they'll run away. So those are the two huge aspect of the latest my experiences in part of the risk mitigation, risk factor, that is definitely everybody has to be concerned about. As far as the debt is concerned, you have to start building reserves to have, knowing COVID and the situation that may come around, minimum, you gotta build in 6 months worth of reserves for your mortgage payment. That way, in a down and out period, you're still able to kind of manage it, and then hang on to your I guess the credit part of it, your net worth, and then your credit scores.
Yeah, there are a lot of balls up in the air there, and you got to try and keep them in the air, keep them from landing on the ground. So that's good. Hey, Vimal, where can listeners go if they would like to learn more or connect with you?
Yeah, so you can look me up on LinkedIn at Vimal Q, on Twitter as well at Vimal Q, and my hotel website is qhotels.co. So you can find me at either one of those three places.
Awesome. Well, Vimal, I can't say thanks enough for taking the time today. I've enjoyed our talk, learned a lot, and look forward to doing it again soon.
Okay, great. Thanks for having me.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.